And Jayakumar joins us. It's been a while we haven't spoken to him. So nice to have him back on the show and especially live in our studio. Good morning. Thank you for joining us.
Morning.
It's been one of the strongest summer rallies of all time. We're calling it the summer rally of 2023. So do you think the summer rally will change? Has it, because the season has changed? Summer is over, monsoons have started. Actually, monsoon is getting over also now. What do you make of the market texture?
I think there's no question that money will keep coming in. The problem also is that there's enough and more in terms of supply of paper that's there, which is either in terms of promoters selling, blocks being transacted in the market, private equity funds getting exits. So I think there's a fair amount of supply of paper also. From that perspective, I think the index may well be, I would say, range bound in a 10% range. I would say 18.6, 18.7 on the low to about 20,200. Could be 20,200, 20,000. We may, during the year, probably around Diwali, test that level. But I think we may find that we are expensive and therefore that range may continue to be that 8 to 10% range from 18.6, 18.7 to about 20,200.
Is the bias of the range up or down?
I think the bias needs to be towards stocks rather than towards the indices, because I don't think any individual investor actually captures the nifty movements, just by investing in, let's say, ETFs or whatever. I think people invest in stocks, and I think the important thing is to identify where the sectoral biases are. So for a long time, tech and financials led the way. My own assessment is new rallies need to happen in new sectors. So defense was one that played out. Could there be other themes? Pharma has been a theme that's taken off the last 1 quarter. I dare say it's not a 1 quarter theme. It's going to be there for multiple quarters. There are massive tailwinds in its favor. There's even a press note that talks about generics being prescribed or needed to be prescribed by doctors, etc. So essentially what you're seeing is here, new sectors come through, reasons follow. And I think pharma could well be that space because exposures are low, funds are not positioned towards it. Foreign funds are, very light on pharma at this point in time. So there could be, if people are focusing on export-led sectors, you could have a move out of tech into pharma continuing. I think it has already begun. Strangely, I think the well-integrated, consolidated metals and commodity players could also be in focus. I think especially the well-integrated steel sector could be like a new pharma in a mini sense, where the worst is taken care of. I mean, we had prices that went up to 85, 87,000 rupees a ton. And today they're at 57, but their margins are better at these levels because input prices have collapsed.
Yes.
And the government is not focused on prices now because from the end consumer point of view, he's not seeing 87 but 57. And yet companies are better off. I think here is where the China factor is actually playing in our favor, where the deflationary trends there means that the consumption of commodities, especially the inputs, are extremely muted, and that's what's poison for one is nectar for the other kind of thing. So really speaking, I think there are sectors emerging. You need to be sector focused. I think the Nifty is really a feel good kind of thing. I mean, if it's broadly in this range with a 19 prefix, I think people feel broadly good about it. Money will keep coming in, SIPs will come in. But the real story is identifying, I think, sectors that are early stage where every downside is factored in or discussed, and virtually everybody knows about China. I mean, you talk to people who, anyone on the street, they'll say, China's got a problem, age issues against them, consumption not taking place, etc. So what is the big takeoff from there is this. I think Europe is still in some kind of a problem situation. But even there, for instance, the EMA has talked about increasing generics use rather than patented products to bring down costs for individuals. So I think if you see those, pharma and steel to me offer great scope in the next few quarters.
But when you say pharma, are you betting on an across-the-board move, or do you have to be selective when it comes to pharma?
I think
because each and every company has a different story.
I think it's principally led by the US markets, where again the move to generics is very clear. The FDA clearances have been much faster than before. Pricing pressures have eased. Shortages have existed. I mean, I've never in my life seen shortages in terms of the pharma except during COVID, etc.
So I think started again in US.
It's started again in the US. The US markets and as I said, the pricing pressures are making people move into generics in Europe. So if those two markets leading the way, in fact, strangely, the Indian markets have not shown, the domestic formulation business has not shown that kind of an offtake, but I think it could follow. So pharma from an international perspective, so those who are generics, export oriented, they could be it. There's an interesting play. Some of the companies here, and I don't talk stocks, so I'm kind of referring to them, alluding to them, if you will, that which have PLI built in. Where the PLI essentially allows you to become more domestically, independent of international critical inputs, whether API or intermediates. And from that perspective, one or two companies that are in the PLI space could stand to make serious money over the next few years, because there are government incentives in addition to getting independence on the, being independent and integrated on the input front. So I think to me, pharma is a sector and a few stocks within. Steel, again, well consolidated, the top 2, 3, low on leverage, that's the way forward. So you're low on leverage, you're expanding through internal accruals. Your margins are expanding at these levels. The government is not putting pressure. And, overall, so these are two big sectoral plays that we are focusing on at this point in time.
Jakes, but the whole appeal that Indian pharma companies have got a huge generic case is almost like a 10-year story. We've seen so much of cyclicality played within that it absolutely amazes me. There was a time when Lupin had margins of 25%. Now the margins 2 quarters ago, they plummeted to 7-8%. Ditto for Aurobindo Pharma, ditto even for Glenmark. It's getting hard and hard to decipher that whole picture now.
Well, if it was easy, we would not be investing. So
that's why we have you.
No, I think the thing to see here is that generics as a theme may have had its second coming in a sense, because today, I think approvals are, becoming a lot more, Indian companies are getting a lot more focused on compliance and approvals than ever before. So a lot of investment has gone into that. Number two, approvals, as you see recently, are also more forthcoming, which therefore we become a need of that market, not the other way around. If you see the commentary of various things, they're talking about pricing pressures easing off. So while you're right about the cyclicality of it, I think the problem also has been that these, the pharma stocks have been, are trading at multi-year lows, if you take a quarter ago, in terms of multiples. So from that point of view, they offer a lot more, so the worst was kind of factored in. And in the markets, remember one thing, when the worst is factored in and there's no limited downside, then effectively only upsides emerge. And the reasons follow later. It's true for steel. I see it being true for pharma in the same sense.
Why steel? I mean, is it because of China or is it
because I think a year before elections to 2 years after elections is the highest amount of capex. That is a capex-led economy for the moment. That's number one. Number two, post high interest rates in the world, whether you take World War I, World War II, when interest rates spiked up, post that the greatest amount of thrust any government gives is on infrastructure and real assets. So that's going to be the way forward. So when you can't, and especially with the kind of layoffs that there are in the on the tech front, courtesy everything from AI and other tools, I think governments world over will go back to the age-old. I would not say do what the Chinese did, which is break bridges to remake bridges for GDP, but essentially that kind of a thing, which means whether if you see now a lot of travelers into the US will talk about airports taking on a much better look there and looking almost as good as Indian airports, quote unquote. That's true for a lot of the highways, roads, pipes, I mean, I can just name industry after industry which needs revamping in the US. They talked about a $2 trillion infra package. I'm not sure how far that's gone down the path, given their own issues. But I think the way forward will have to be infra and will have to be, so I think steel is a beneficiary there. Prices have come down, but margins have improved. I think that's the big take.
You alluded to defense as a sector also earlier. Is the meaty rally over there, or do you think there's still to go?
I think it's substantially over.
Substantially over.
So when people start focusing on, when fund houses start launching defense-specific funds, you know that the rally is pretty much over for now. And then there's organic growth. So it could come from many spaces. And also remember, like infra, like capex related, cap goods related, you have defense also as a pre-election build-up.
Yeah.
And that's kind of played out.
What's
Rather
the outlook?
short-lived, one must say, right? Barely a year and a half.
To be frank, Mazgaon Shipyard and some of these companies,
Yeah.
they actually always existed. They were always in defense. It's just that post-COVID, when you started ring fencing the entire sector, you gave Indian defense companies PLI benefits, the private guys came in, you made it mandatory to outsource from local, which is the word Indianization. And I think there was an import ban on more than 100. We are remembering Rakesh Jinwala today, first death anniversary, and I remember Jake's a chat I had with Rakesh Jinwala in 2014, and he said that India, the next big boom in defense is coming. I mean, his vision to see what could be called as a trend 3, 4, 5 years ahead of that actual occurrence was extraordinary. We all miss him.
No question about it. I mean, very, very dear friend, and it's a kind of a humbling moment to sort of just look back and talk about him in the past tense effectively.
Yeah.
I mean, he's been a good friend of a lot of channels, you personally, and certainly a very dear friend of mine. So we continue to miss him on a regular basis, not just today as it were, because that whether it's a call at 8 o'clock to say what are you doing, let's sit and chat, and a 10-minute chat becomes a 4-hour chat,
It would start from 9 and end in Jeffries, right?
Well,
Back in the day.
considering I'm a teetotaler, it kind of, for me it was slightly.
Ended there.
We were also neighbors, so it usually.
Oh yes, you shared the house.
Yeah.
the old
So we
house.
were actually, we used to meet up pretty often, late evening. But yeah, sure. I think you remember legends, and you remember. I think it's one of a kind. I mean, you will stretch hard to, rediscover another Rakesh Jhunjhunwala in our midst, as it were. So.
Yeah, and leaving behind a wonderful legacy at that. What about your outlook, Jakes, when it comes to the broader markets? You're talking about a range for the index, but do you think that it's going to get a bit frothy when it comes to mid and small caps?
I think it's already frothy there. I think if you see the kind of, mad scramble in stocks and this entire ESM framework which, SEBI has imposed with modifications, most of the modifications nobody understands, but that apart, I think it's, other than restricting trading, if you will, that clearly is an indication of prices that have gone, that go crazy. So in every market you will see this, and because people are feeling left out, they haven't come into the frontliners. So paradoxically, I think there's safety in the frontliners as compared to some of the small and mid caps.
Jakes, is there a genuine case now to revisit consumer tech and fintech stocks, because the business have survived, free funding is over, and the promoters have realized that look, they are no longer in the IPO, in the PE market, they are in an auction market where they would be judged on a daily basis. So that late realization, I think, is become the new truism for them.
Well, I mean, if you're talking about the new age companies specifically, I think, when headlines hit you, it says that after 15 years, one company XYZ makes a profit for the first time. You just realize the amount of money that has backed them.
Yeah.
And they have been, in a sense, pampered by. So, in a cement case, for instance, you have a capex defined upfront, and maybe some capex before you break. And some sort of burn, if you will, before you break even. Here, the capex is defined as the amount of funding that goes on and on before you finally have a quote-unquote profitable model. I mean, profit was meant to be the first objective, not funding. But so I think the way we assess these has changed. I still think many of them are quoting on the severely on the right side of excessive. So they are still excessive, no question. I mean, many of these companies which listed in the last 2 years have market caps of 40,000, 60,000, 80,000 crores.
Zomato is nearing 1 lakh.
Well,
Policy Bazaar is 45,000.
Well, and the others which we...
Paytm.
So these are
72,000,
not cheap by any stretch. I mean, not to forget, many of the companies in the Tata Group have taken 150 years to get a sustainable 1 lakh crore market cap. So you do wonder whether, and especially given the overbearing nature of tech that is involved, that what can disrupt some of these things. Of course, it's true that some of these have become habit formation. We order our food, we order our cosmetics, we order our various things, pretty much online. Are we willing to pay excessive amounts which are left behind as margins for these companies? I'm not so sure. So I think you will come to a situation where some of these companies will hit the market for new rounds of funding, as is happening in the case of Farm Easy and others which we hear about, right?
Yeah.
Where they are going in for new funding. And funding is, again, an important pointer here. In a listed company, when you need funding, you go for a rights issue, supposing, and you go at a discount to market to price it to sell. The unlisted scenario is the only aberration in the world where you price it higher than the previous round, as though that's God ordained, right? And that 4 out of the 5 investors put in new money, and they wait for the one bakra to come in and sort of make up the ratify, saying the
Deficit.
outside investors also put in. So I think all that's going to change. So people, and like Pharmacy has realized that whatever price you're able to raise money, please raise, because survival is the most important metric right now. We'll talk valuations later. So I think some of these new age companies will be seeking new funding. And to my mind, that's when they start getting derated, because you got to price it then to sell, not price it from a valuation perspective, which many of these investors still have, some of the age-old investors still there. That's why you hear Paytm, some of the Ant Financials and others selling out. Of course, it still amazes me that some of these promoters, like we heard about a recent deal, will actually buy out some of these people in deals offshore or onshore. I mean, if ludicrousness had an extent to go before, I think this kind of scales way beyond all that.
I mean, Paytm is right hand moving it, giving you to left hand. As simple as that.
But hasn't a lot of the derating has already happened, right? How much more will they fall?
If derating has happened at 50,000 crores, there are 4 zeros after a 5. After a 5, so so let me not say where the derating stops. As again, to quote Rakesh Jhunjhunwala on a day like this, in a bull market, don't seek the top. When derating, i.e. a bear market, don't seek the bottom.
So what is the top for this market?
We don't seek it, because I think it's a bull market.
It's a bull market.
But if in individual stocks corrections continue to happen while the markets move up, sure they can.
What is the importance of the next year's election cycle? Today we are not talking about it. But 6 months from now, 1st of January 2024, everybody will talk about it.
Sure.
So for a long-term portfolio investor, when you know that election cycles in India historically, unlike a lot of other countries, they have played an important role. A 5 to 15% swing is something which is considered to be par for
the
course.
course.
What happens to that setup?
I'm not making predictions, but I think over a period of time, we started saying budgets don't matter. Through elections, I think we've realized long-term portfolios don't matter. But a positioning for the short term, can there be a black swan event, etc.? By definition, if you can predict it, it's not a black swan event.
Yeah.
So you hope that continuity continues. I mean, that's the only thing. I mean, this is one where I feel a change will not be seen positively. I think we'll need continuity. Numbers can vary. Some may even argue that a coalition with moderated numbers may be a better thing. I'm not a political pundit. All I know is that many of these don't stand the test, way beyond, let's say, a couple of weeks. People tend to forget and move on. But unless something, God forbid, drastic were to happen, I think it'll come and go. That too will pass. But there could be tactical plays which many of the day traders and week traders are significantly more equipped to talk about than I am. And that will continue. But I think the elections are a bigger thing than most budgets. And I think we should be clear that while policies may not change, but it could be sentiment negative if something untoward were to.
Absolutely. Jake's always a pleasure speaking with
Thank
you.
you.
Thank you so
Thanks for
much
having
for
me
taking
over
the
and
time out.
Wish everyone the very, very best.
Yes.
Thank you very much.
Thank you so
Thank you.
much. Oh, by the way,